go to our guest. We have Hemant Kanawala, who is the head of equities at Kotak Life. So, how would you evaluate the market at the moment? You're seeing it largely being range bound. Is this a phase of consolidation, you would call it? How should one look at it at the moment, and in which direction will it move in your view? Will there be more buying opportunities? Is there a larger scope for that going forward?
Hi, good afternoon. See, if you see in last 2 years, broadly the market has been consolidating around this range of 18,000 to 20,000. We made a high of 18,500 2 years back, and we have slightly moved up in line with the earnings. So currently, the Indian micro is doing very well. So corporate India, are reporting strong earnings growth. Even the PMI activity reported is on a good side. So Indian economy is doing well, but we are seeing challenges happening from the external environment. One of the most major headwind is the global liquidity. As you just mentioned, US 10-year is close to 5%, and that will move a lot of liquidity away from risk assets towards US Treasury. And second is the geopolitical tensions, which is raising the price of commodities, in particular oil. Now, oil is a very crucial factor for Indian economy, and if the oil moves above $100, clearly a negative for Indian markets. So we believe that markets will continue to navigate through these challenges, and hence needs to consolidate at current levels. So of lately, we see the large caps have by and large stayed flat, but we have seen a lot of rallies happening on the mid and small cap. But large caps have been concerned, and we believe that that phase can continue for another 6 months. We will also have election uncertainty after 6 months, so that is also investors will have to look through. So we believe that market should spend some more time in this band of 18,000 to 20,000 before making a further progress backed by earnings.
And how do you look at flows at the moment? Because you're seeing good FI selling on a consistent basis when we're looking at it over the last couple of months at the very least. And you're seeing DIs also trying to pick up, investments at as and when there's a slight correction. So you're seeing good support as well coming through, but the upside also seems capped. So how should one see valuations? Because your valuations are very close to your long-term averages, and yet the US 10-year bond yield is at 5%. So how should one reconcile between those two?
So obviously, US 10-year is the determining factor. That is creating the push and pull in the market. So when the market corrects, the domestic investors are providing the support. But as US 10-year is moving towards 5%, the FIs are incrementally moving money out of not only India but emerging markets and moving back to the USA. So this push and pull will continue in the market. But what is heartening is that as US 10-year is moving towards 5%, we are not seeing big spike happening in the Indian 10-year. So on an average in the past, Indian 10-year will have traded at 3 to 4% premium to US 10-year, but today that is practically down to around 2.5%. And there are reasons for it, because the inflation differential between India and US also has come down. And so we believe that there is no reason for big spike in the Indian 10-year, and that will continue to drive valuations of the Indian equities. So with that, I think so. US 10-year moving up is definitely a headwind to all the risk assets globally. Within that specter, we believe India is relatively well placed, and that's where we believe next few months are going to be challenging, and this market can correct down. But that is part of the equity game. We are trading practically close to all-time highs, so we can have some correction on the back of this global liquidity factor, which it will be a healthy correction in our view.
Right, and how should one play that game then, therefore? So there is some downside risk. Should one play in the large cap space because the mid cap and small caps have really given excellent returns year to date overall as a basket? If I can categorize and try and understand how you view three of those baskets, which one would you pick at the moment?
So from a medium-term perspective, I think so. What is important is that every investor should determine his risk appetite and have a allocation towards each of the basket. So it is nothing right or wrong, because if you look at various time frames, one basket will have done better than others. So in the last 6 months, mid and small cap have done much better than the large cap, and that's where it is natural to believe that mid and small cap can have some correction vis-a-vis large cap over the next 6 to 12 months. So it looks overrated. But if you look at a long-term perspective, they can also have better earnings growth compared to large cap. And there are some of the new emerging sectors of the economy are also within the mid-cap space. So we need to look at mid-cap at a more bottom-up perspective than index level. What you normally look at the large caps. And in that view, we believe that we need to maintain allocation. But in the near term, a very large cap looks much safer than mid cap because of the relative underperformance, and valuations are much more reasonable. And that's where current pick will be towards large cap. But as I mentioned, that doesn't mean that investors should book profits totally in mid cap and small cap and move to large cap. They should maintain a reasonable allocation in all the three segments, depending on their risk appetite.
And any sector that you are currently looking at or preferring in terms of valuations as well as in terms of future prospects, which are looking reasonably valued? What are the kinds of sectors that you feel are looking decently valued and could make a good investment at the moment?
So as we discussed, since the global environment is looking somewhat challenging, we are looking at some of the defensive sectors of the economy, and in that currently we like pharmaceutical sector. So pharmaceutical broadly will break up into domestic and broadly US based. So domestic pharma had been doing well for last few years and continues to do well. So they are like a proxy to consumer staple, like very steady business and steady growth, and they are trading at a good valuation. At the margin, what is changing is story is on the US generic side, where we are seeing better pricing scenario over the next 3-4 quarters. The main reason for it is that there is a supply shortage of drugs in USA, due to which the US FDA is having a more favorable outlook towards the Indian generic companies because there is a supply shortage. Because of the pricing erosion, many of the multinationals, US multinationals, are not focusing on a generic segment. So they are going back to their own specialty, and that is making competition less for the Indian companies. So overall, we believe that pharmaceutical sector offers a good hedge in the current environment where we're seeing challenges arising on the growth side.
So I've very quickly, I've been told that I've got very little time. If I can ask you your outlook with regard to some of the defensives, some of the other defensives, like an IT, how does that look at the moment? And also your take on banks.
So IT sector's outlook is linked to US economy, and that is where one of the most uncertainty is there. They had a big rate hikes over last 1 year, but economy is still doing okay, but corporates are not spending, and the outlook is still uncertain. So valuations have corrected. That's where we are not negative on the IT, but to have a positive spin, I think we should wait for the yearly commentary, which will happen somewhere around April. So for the next 6 months, we expect it to consolidate, but it can do better in this challenging times. For the banking, valuations are very reasonable now, and next 3 to 6 months we may see earnings growth slowing down because the base was very high last year. But as we go into FY25, valuations will be reasonable, and we will be looking at reasonable earning growth of around 15% for the sector. So from that perspective, banking looks interesting, and they have underperformed the market in the current year. So banking looks interesting, but in the next 3 to 6 months, it can have challenge because the growth is slowing down because of the high base.
Right. Thank you so much for that, Hemant, for all of those views and for coming and speaking with us today. Thank you so much. Let's